You know, usually when we look at a financial chart, a flat line means basically nothing is happening.
Right.
On the surface, the digital asset market right now looks, well, like a perfectly calm ocean, but underneath, the tectonic plates are shifting in ways we really haven't seen since the network's inception. So, welcome to the week that was.
Glad to be here.
Today, we are taking a deep dive into a massive stack of source materials. We've got structural market reports, some heavy cryptography notes, and a whole bunch of global regulatory filings.
Yeah, it's quite a stack.
It is.
Yeah.
And our mission today is to look past the utterly boring price action and, uncover the actual architectural rewrite that's happening in the background. Because frankly, if you are just checking the price tracker on your phone, you are missing the real story entirely.
Absolutely. I mean, the contrast between that surface level stability and the actual underlying plumbing of the market is it's staggering.
It really is.
We are looking at a space that is being simultaneously squeezed by these huge macroeconomic liquidity vacuums while also being revolutionized by artificial intelligence power demands, and on top of all that, threatened by quantum computing advancements.
Right. And that is exactly the journey we are taking you on today. We're going to explore this illusion of institutional buying and then a massive physical pivot where infrastructure operators are just, well, abandoning the network to power AI models.
Which is fascinating.
Completely. And then we'll get into a ticking quantum clock that's forcing developers into this impossible philosophical corner. And finally, a tangled web of hardware failures and global regulatory crackdowns.
Because every single one of these threads, they connect to the exact same underlying tension.
Yeah.
It's the transition of this technology from a sort of ideological experiment to a heavily financialized, strictly regulated global utility.
So let's start with what everyone naturally looks at first, right?
Yeah.
The price. It has been stubbornly range-bound, like trapped roughly between $61,000 and $66,000. But if you look at the exchange-traded fund data in our market reports, U.S. spot ETFs look like incredibly bullish.
Yeah, the numbers are huge.
We are seeing multi-day inflow streaks totaling over $600 million. BlackRock's fund alone pulled in nearly $200 million in a single day recently.
Okay, let's unpack this because, wait, back up.
Sure.
If I buy an ETF, I am bringing actual cash to the table, right?
Right.
So if hundreds of millions in cash are flooding in, how is that not creating massive upward price pressure? I feel like I am missing the leap here.
Well, you are assuming that those inflows represent directional momentum, like people wanting the price to go up.
Well, yeah. Why else buy it?
The critical distinction here is between a directional bet and delta-neutral arbitrage.
Okay.
The institutions driving these massive ETF inflows, they're not buying because they think the asset is going to the moon. They are buying to capture a yield spread.
So they're basically farming a premium.
Walk me through the actual mechanics of how that nullifies the price action, though.
Right. So right now, the market is in contango.
Meaning the futures are more expensive.
Right. The perpetual futures contracts trading on offshore exchanges are priced higher than the spot market. So institutional trading desks see this gap.
Mm-hmm.
They buy the spot ETF in the United States, which registers on the charts as a massive bullish inflow. But at the exact same millisecond,
Oh, they hedge it?
they execute a short position on the offshore futures market to hedge that exact purchase.
Wow. It is like looking at a crowded restaurant where it seems like business is absolutely booming. But if you look closer, everyone is just using discount coupons and drinking tap water. Like the sheer volume is there, but the organic demand really isn't.
That is a highly accurate analogy, actually. The trades perfectly cancel each other out in terms of market direction.
Right.
The institutional desk captures the yield difference, the premium between the spot and the futures price without taking on any actual price risk.
So it looks active, but it's totally flat.
Yeah, it adds massive transactional volume to the network, but it completely nullifies upward momentum. We call it a ghost inflow.
And ghost inflow. Okay, that totally explains why we aren't breaking through the ceiling. But what is keeping the floor so fragile? Like, why is there so much friction preventing any real organic capital from entering the space?
Well, for that, we have to look at the macroeconomic headwinds. They're acting as a giant vacuum on global liquidity.
Like the Treasury stuff.
Exactly.
Mhm.
The U.S. Treasury recently announced plans to borrow $739 billion for the quarter.
Which is an insane amount of money.
It is. And when a sovereign government issues that massive amount of debt, they have to find buyers.
Right.
Those buyers use capital that would otherwise be, circulating in the banking sector or flowing into risk assets. So the Treasury is literally draining liquidity from the system to fund government operations.
And risk assets historically require an expansion of fiat liquidity to sustain any real price appreciation.
Precisely.
If the Treasury is soaking up all the spare cash, the broader market just starves.
The math backs that up entirely.
Yeah.
And you have to compound that domestic liquidity drain with the joint U.S. and Japan currency intervention we just saw.
Oh, the unwinding of the yen carry trade.
Yes.
I want to make sure we are clear on how this specific mechanism impacts digital assets, because it sounds purely like a Forex thing.
Well, what's fascinating here is how interconnected global leverage truly is. For years, investors borrowed Japanese yen at near zero interest rates.
Right, because money was basically free there.
Exactly. They converted it to dollars and bought high-yielding risk assets globally.
Including digital assets.
But when the yen plummeted recently, the Bank of Japan and the U.S. intervened. They sold dollar reserves to buy yen.
Which pushed the value back up.
Right. This caused the yen to appreciate rapidly, so suddenly, all those investors who borrowed cheap yen were entirely underwater on their loans.
So margin calls hit across the board. They are forced to liquidate their high-yielding risk assets just to cover the deficit on their yen loans. It is forced selling, completely divorced from the fundamentals of the asset itself.
Which is why the price is flatlined. You have Wall Street executing delta-neutral hedges that cap the upside, and macro liquidity drains, forcing sales that pressure the downside.
Man. Okay, here's where it gets really interesting, though. If the financial layer is starving for liquidity, how on earth is the physical infrastructure surviving?
That's the billion-dollar question.
Because we have an entire industry of physical operators who invested billions in hardware and power grid to secure this network. If the price is flat and economics are tightening, how do they keep the lights on?
Well, for many of them, the answer is they don't, at least not for this network.
Wow.
We are watching a massive architectural pivot where the biggest infrastructure operators are completely abandoning digital asset mining for artificial intelligence and high-performance computing.
Just to put numbers to the brutality of the current environment, our notes show network hash price, the expected revenue per computing unit, is severely compressed.
It's historically low.
The production cost to mine a single coin right now sits around $60,000 for highly efficient facilities. But for older operations, that cost pushes $95,000.
Right.
So they are bleeding cash every single time a block is validated.
It is entirely unsustainable. But these major infrastructure operators realize something crucial. They have massive industrial power facilities.
Right.
They have advanced liquid cooling systems and secured regulatory real estate.
Basically everything AI needs.
Exactly. They hold the exact bottlenecked resources that the generative AI boom desperately needs, which is ready-to-use electrical capacity.
Let me push back on that, though.
Right.
Aren't these companies fundamentally changing their entire corporate identity?
Well, yeah.
It feels like a gold mining company, realizing they can make 100 times more money by simply renting out their heavy machinery to a Silicon Valley tech firm instead of actually digging for gold.
That's pretty much what's happening. The raw economics dictate the shift, regardless of their original corporate mission.
Right.
Let's look at the actual yield. Traditional network mining currently yields roughly $80 to $120 per megawatt hour of electricity used.
Yep.
High-performance computing for AI models, that yields between $1,500 and $3,500 per megawatt hour.
Wow. I mean, it is not even a competition. But wait, why wouldn't AI companies like Anthropic or OpenAI just build their own data centers? Why rent from these miners?
Because securing a 400 megawatt grid interconnect in the current regulatory environment takes 5 to 10 years.
Oh, wow. 5 to 10 years.
Yeah. You have to deal with local utilities, environmental impact studies, grid stability assessments, all of it. The miners already did this years ago.
Right, they're already plugged in.
They already have the substations and the transformers running, and time to market is everything for AI right now.
Which totally explains the massive reallocations we're seeing in the filings. Like, TeraWulf just reported that 71% of its recent revenue came from high-performance computing leasing.
Yeah, that was a huge pivot.
They finalized a 20-year, 401-megawatt lease with Anthropic that projects up to $33 billion in contracted revenue. $33 billion.
With a B. It's massive.
And Bitdeer is doing the exact same thing. They're signing a 16-year, $4.7 billion deal for a facility in Norway running on renewable hydropower.
If we connect this to the bigger picture, this changes the entire cost floor of the decentralized network.
How so?
Well, if the major, well-capitalized operators are diverting their power capacity to AI, the available energy and hardware dedicated to securing the network shrinks. It forces the remaining mining operations into this brutal consolidation.
So we are watching the physical infrastructure just bleed out to AI server farms. But does that massive physical pivot leave the digital infrastructure vulnerable? Because honestly, we need to talk about the cryptographic threat looming over all of this.
Yes, it is the single most significant existential threat to the network's architecture, and the timeline is accelerating far faster than anyone anticipated.
The Google quantum stuff, right?
Right. Google's quantum AI team recently published data showing that the number of physical qubits required to break elliptic curve cryptography has dropped from 20 million down to under 500,000.
Okay, I understand a quantum computer is incredibly fast, but what is the actual mechanical vulnerability here? Like, why are legacy public keys suddenly a massive liability?
It basically comes down to Shor's algorithm.
Okay.
The network's security relies on the mathematical difficulty of deriving a private key from a public key. For classical computers, factoring the massive prime numbers used in this cryptography would take millions of years.
So it's virtually impossible right now.
Exactly. But a sufficiently stable quantum computer running Shor's algorithm can solve that math and derive the private key in minutes.
Just minutes, and the exposure here is terrifying. According to the structural reports, over 6.04 million coins, which is roughly 30% of the total supply, are currently sitting in legacy addresses.
Yeah.
These are mostly pay-to-public key addresses from the early days of the network, where the public key is fully exposed on the ledger.
Right. So if a bad actor or, say, a hostile nation state gets a stable 500,000 qubit system online, those legacy addresses are entirely vulnerable.
They wouldn't even need to hack anything.
No, they wouldn't even need to hack a network node. They could simply look at the public ledger, run the algorithm, derive the private keys, and drain 30% of the total supply.
To counter this, developers are fiercely debating a Bitcoin improvement proposal known as VIP 361. It proposes a strict timeline to force the entire network into quantum-safe address formats. But reading the developer notes, this is absolutely tearing the community apart.
It really is. The controversy centers on Phase B of the proposal.
Right.
Phase B is effectively a hard fork that would block incoming payments to legacy addresses and eventually invalidate old cryptographic signatures entirely over a 5-year migration window.
Meaning if you don't actively move your funds to a new quantum-safe address within that specific time frame, your assets are frozen.
Right.
Like permanently.
Exactly. It mandates network-wide participation. You cannot passively hold the asset through this upgrade.
What stands out to you listening to this, because we are no longer talking about a simple software patch, this is a massive philosophical dilemma.
Oh, absolutely.
If Phase B is executed, it freezes all dormant, unmigrated assets. That includes the roughly 1.1 million coins mined and held by Satoshi Nakamoto, the pseudonymous creator of the network.
And this raises an important question about the actual soul of the network. The foundational tenet of this technology is absolute property rights.
Right, censorship resistance.
The core marketing pitch has always been that nobody, not even the developers, can seize, freeze, or alter your holdings.
Not your keys, not your coins. The ultimate bear asset.
But you know, if they maintain that ideological purity and do nothing, Satoshi's 1.1 million coins plus 5 million others will inevitably be stolen by a quantum-equipped thief.
Which would just destroy the market.
It would completely collapse the market value of the entire ecosystem. So the developers have to choose. Do we intentionally violate our own founding principle by freezing the creator's wallet, or do we risk catastrophic systemic theft?
Man, it is the ultimate test of decentralized governance. And frankly, while developers are debating a theoretical quantum apocalypse 5 years from now, the present reality is an absolute minefield.
Yeah, the immediate issues are severe.
Let's look at the friction we are seeing right now across legal, accounting, and security sectors.
While the daily operational environment is incredibly hostile right now, on the security side, we just saw a massive exploit of the CoinKite cold card hardware wallet.
Right, resulting in over $100 million in stolen funds. And this wasn't a user error, right? It wasn't like a phishing scam where someone just handed over their passwords.
No, this was a deep architectural flaw in the pseudorandom number generator, the PRNG, during the actual offline creation of the seed phrase.
Okay, swim on that a bit.
The hardware was supposed to be generating true mathematical entropy, randomness. Instead, it was relying on a flawed algorithm that produced predictable seed phrases.
Oh, man. So attackers simply reverse engineered the math and drained the wallets.
Exactly.
So self-custody is suddenly terrifying for the average user because even open source hardware can harbor these fatal mathematical flaws.
And we saw the reaction.
Yeah, the reports show a massive flight of retail assets moving back to centralized exchanges after that exploit. But the institutional side isn't faring much better. Walk me through what is happening with corporate treasuries, because the filings show entities are just bleeding out.
It's true.
Former President Trump's media company, DJT, just liquidated 63% of its digital asset reserves to maintain operational solvency.
Right. And it isn't just forced selling for operational cash flow. The accounting framework itself is actively punishing companies that hold the asset.
The FASB rules.
Yeah, we have to look at the new FASB fair value mandates. The Financial Accounting Standards Board recently changed the rules, forcing public companies to report their digital asset holdings at fair market value at the end of every reporting period.
Okay, walk me through how these mandates actually create friction. Like, if a company like BigGo or Strategy Inc. hasn't actually sold the asset, why does the accounting framework hurt them?
Well, previously, digital assets were treated as intangible goods. You only reported a loss if the value dropped, but crucially, you couldn't report a gain until you actually sold the asset.
Right, that was the old rule.
Now, under the fair value mandate, they must mark their holdings to the current market price regardless of whether they sell. So if the market experiences a heavy dip on the last day of the fiscal quarter, the company takes a massive non-cash impairment loss directly on their income statement.
Even if the price recovers the very next day.
Precisely. To traditional equity investors reading a quarterly earnings report, a massive impairment loss looks like severe corporate mismanagement.
Right, it looks like they're failing.
Exactly. It terrifies shareholders and creates immense career risk for any corporate treasurer trying to hold the asset on their balance sheet.
And that is just domestic corporate compliance. When we look at the geopolitical compliance layer in our sources, it becomes an absolute nightmare.
Oh, the international side is even more complex.
The U.S. Treasury's Office of Foreign Assets Control, OFAC, just dropped the hammer on the Dubai-based Shellbit exchange and Iran-based Evaman Tether.
Right. They were sanctioned for laundering roughly $4 billion.
$4 billion.
But the critical structural detail in those filings is the actual origin of the funds. A massive portion of those routed assets originated directly from state-sponsored mining operations conducted by the Islamic Revolutionary Guard Corps.
Wow.
They are using heavily subsidized state-controlled power grids to mine blocks and generate fresh, untracked liquidity.
So the U.S. government is actively tracking and blacklisting specific transactions tied to these state actors. But at the exact same time, Russia just threw a massive wrench into global compliance by fully legalizing cross-border digital asset settlements for their corporate entities.
Yeah, they are explicitly using the network to bypass international banking blockades.
Which shatters the entire concept of fungibility for Western institutions.
It absolutely does.
If you are a regulated asset manager in New York or London managing an ETF, you now have a massive systemic compliance burden.
Because the network operates on unspent transaction outputs, or UTXOs.
Right.
If a Russian corporate entity or an Iranian state mining pool processes a transaction, those specific UTXOs are forever tainted in the eyes of OFAC.
So a Wall Street bank has to deploy highly advanced chain analytics just to guarantee that not a single fraction of a coin in their custody vault has ever touched a sanctioned entity, or they risk massive federal fines.
Exactly. The operational overhead must be astronomical.
It has to be.
If we connect this to the bigger picture, it is fundamentally rewiring market structure. The industry spent a decade begging for institutional adoption.
Yeah, everyone wanted the Wall Street ETFs.
They wanted the corporate treasuries, the massive liquidity, but when you invite the traditional financial system in, you don't just get their capital.
You get the baggage.
You inherit their regulatory warfare, their accounting friction, and their geopolitical compliance mandates 24/7.
And it is completely breaking the legacy platforms. We are seeing offshore exchanges like BitMEX accelerating their complete operational shutdown because they simply cannot compete with the compliance modes of these institutional players.
Right, they can't keep up.
And domestically, the regulatory turf war is just paralyzing innovation. Look at the massive legal battle over prediction markets like Kelshi and Polymarket.
Yeah, the Commodity Futures Trading Commission is attempting to classify these platforms as federally regulated swaps, demanding full oversight.
The states are stepping in.
Right. State attorneys general are fighting back, arguing it constitutes illegal state gambling. We recently saw a federal judge rule that CFTC oversight does not automatically preempt local anti-gambling laws.
Leaving these platforms in totally complete legal purgatory.
Exactly.
So,
Yeah.
what does this all mean? Look at the paradox we have laid out for you today. For the average user, holding your own keys is terrifying because of unpredictable hardware entropy slots.
Right.
But handing your assets over to an institution means your wealth is suddenly bogged down in FASB accounting hits, federal versus state legal battles, and global OFAC sanctions tracing.
The entire ecosystem is really just caught between a rock and a hard place. The infrastructure is being squeezed from every possible angle, from the macro liquidity layer all the way down to the physical silicon.
Yeah, let's pull all of this together. If you were wondering why the price chart looked like a boring flat line this week, you now know that the actual foundation of the digital asset space is being radically dismantled and rewritten.
That's the real story.
We've explored how institutional delta-neutral arbitrage is creating massive ghost volume. We have seen the raw economics forcing the massive physical power grids built for mining to be rented out to artificial intelligence.
Which changes everything.
We have unpacked the mechanics of Shor's algorithm and the quantum threat that is forcing developers into a philosophical corner over Satoshi's frozen wealth. And of course, we have navigated the absolute minefield of PRNG hardware hacks, fair value accounting mandates, and international UTXO sanctions.
The surface is calm, but the structural integrity is being tested in unprecedented, highly complex ways.
To you listening, thank you for joining us on this deep dive into our sources. We know there is a massive amount of noise out there, and our goal is to ensure you walk away as the most well-informed person in the room. You now understand the hidden mechanics behind the headlines. You know the why and the how of the week that was.
And I will leave you with this new thought to mull over.
Okay, let's hear it.
We have talked about AI capturing the physical infrastructure of this network, but if artificial intelligence models continue to scale their operational autonomy, it is highly likely they will eventually need their own native capital to pay for computing resources, data scraping, and API calls.
Oh, wow.
Does the ultimate end state of this technology bypass human users entirely?
That's wild.
We may be witnessing the early stages of this asset becoming a closed, automated financial system where AI agents are the primary holders, validators, and transactors, leaving humans completely out of the loop.
Man, that is the question of the decade. Until next time, keep looking beneath the surface.